Price matters all the time. We're now 10, almost 15 years into the shale boom. What that means is we've drilled up the best prospects, and U.S. shale, which is, a dramatic force in the oil markets, is starting to mature. So we expect that it will take increasingly higher prices to justify increasing levels of production or even maintaining current levels of production. Drill, baby, drill. It doesn't make sense with oil in the 60s or the 50s. And so over time, if we're going to see shale continue to maintain its current output levels, we're likely going to have to see WTI oil in the 70s or 80s. And so the price setup isn't great right now. Shale's maturing a bit. We've seen rig count come off as companies have maintained their capital discipline. They want to keep returning free cash to shareholders. And so they're scaling back their investment plans. So right now, relative to the hope of the U.S. administration of increased production, we're probably going the other direction in the short term.
So, Dan, walk me through what this means politically, because President Trump, when he came to office, of course, promised to unleash American energy and, yes, drill, baby, drill. It's unlikely he's going to be able to achieve that if we see lower prices and rigs at idle.
I think what Trump wants most of all is lower prices, and he's getting them. He asked for drill, baby, drill from the U.S. industry. It didn't respond. And so what have we seen? Whether by working together with Saudi or happy coincidence, what we're seeing is that increased supply is coming from OPEC Plus. Prices have moderated. That's good for inflation in the U.S. It also gives the U.S. a fairly significant amount of headroom here, if you will, around the geopolitical side of things, the negotiations with Iran, what's going to happen with Russia. And so rather than starting with an oil price in the 70s that might spike $10 a barrel because of geopolitical issues, now we're starting with oil in the low 60s. So a lot more maneuvering room, if you will, on the geopolitical front, and a lot better shape from the inflation front. So we're getting the lower prices that Trump wanted. I think that's what he cares most about. And U.S. industry still relatively dominant at 13.5 million barrels a day. So we've got the energy independence and we've got the lower prices. We got there a different way than I think the administration expected 6 months ago.
Yeah, indeed. So the question now is, particularly as we watch the US E&P shares coming back online later in the session, what does all of this mean for the investment case in the US shale patch? Has this EIA report effectively killed that, Dan, for 2025?
I think it is a tough dynamic when you're looking at flat to down production and lower prices. And so what that says is right now the industry has generated pretty good free cash flow. The valuations of these shares are relatively inexpensive. Doesn't look like there's a ton of catalyst for the rest of the year. If anything, the downward pressure on price is likely to be an overhang on the shares. And so I think what you look at here is a value sector. It's inexpensive, doesn't have great catalysts, and probably the next meaningful uptick comes with price in the 70s, which, forecasting price is hard, but that feels like that's a later in 26 event, not a later in 25 event. So tough market for the sector right now.
Dan, of course, we also look at this through the lens of the Middle East, and in particular, the output that we see from OPEC+. What's also been interesting is trying to make sense of these recent decisions to increase output. And now the EIA report also attempts to put that into context, because as we see US output potentially falling through the course of the year and OPEC Plus output potentially increasing further, it means that the game of market share may be being won by the OPEC Plus players. Would you agree with that?
I absolutely agree. I think what we have in the near term is OPEC is going to win the market share war in the next 18 months. Are you really winning when you're winning from the perspective of the likely downtick in price? But I think what's really important is that as we step out over the next 5 years, what we're doing is we've got OPEC oil that is likely to take a meaningful amount of share, not just over the next 18 months, but maybe over the next 5 years. Why? Puts US shale on its back foot, helps stimulate demand, and the barrels that we know are out there in terms of existing capacity reside in the Middle East. So OPEC has maybe pushed their way into the market in the short term, but they've got the barrels to stay there in the longer term. So this looks like a move that the Middle East is going to win from for a fairly meaningful period of time.